Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to another episode of the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. Now recently, what we've seen in commodity markets have been very interesting. And I'm not talking about iron ore, which is obviously a staple of what we dig up here in Australia and export, but the actual precious metals of gold and silver, and the rise of gold and silver. Now, everything I'm going to talk about, as always, is not personal financial advice. It is simply for entertainment purposes only, and please listen to the disclaimer at the end of the episode. But it is a very interesting topic to delve into because it has other flow-on impacts that we don't know a lot about. What we do know, though, is gold and silver have both surged over the last couple of years, but they are rising for different reasons, and in actual fact are sending different messages to the market. When precious metals move together, it's rarely a random set of events, and it usually reflects deeper shifts in the global monetary system. Could be something to do with geopolitics, and obviously geopolitics has been a big deal around the world recently. And what is the real world situation with supply and demand? Now, right now, the data behind gold and silver suggests something structural is happening rather than a short-term trade. Now, one of the big problems with investing in gold historically is that it's not an income-producing asset, right? It's very boring. You put money to a term deposit, you get yield. You invest in a government bond, you get yield. Gold doesn't produce anything. It doesn't generate any form of cash flow. It has no profit or what we call earnings growth in the industry, and it doesn't produce dividends. Now, if we look back into history though, gold performs best when confidence in money, actual fiat, currency, policy, or financial stability starts to erode. And it seems like what's happening in the geopolitical environment is leading to this situation to arise. In 2025 alone, the price of gold rose about 64%. A move that's large enough that even central banks and sovereign balance sheets materially benefit from the rally. And one of the strongest and most unappreciated drivers of gold's rise has been central bank demand. To provide some historical context, in 2022, central banks bought 1,082 tons of gold. Now at that time, was the largest annual purchase on record. In 2023, they followed that up with another 1,037 tons, which, is not a huge move. And that was the second largest year ever recorded. Then we had 2024, and central banks again bought more than 1,000 tons of gold. And this marks 3 years in a row that purchases were above that level, or above 1,000 tons. That's unprecedented in modern financial history. And when central banks act consistently over multiple years, it's not speculative behavior, it's strategic in nature. And gold is being accumulated as a reserve asset that sits outside the global financial system. It's no one else's liability. It can't be sanctioned, you can't freeze it, and you can't default on gold. And in an increasingly fragmented geopolitical environment, that neutrality has real balance sheet value. Now, geopolitics, and let's be frank, the trade war that Trump started last year in April, right, which is what created the funny taco trade of Trump always chickens out, geopolitics seems to be a central player in this shift, right? As sanctions and trade restrictions and financial weaponization become more common, countries are reassessing the concentration risk within their reserves, where historically the US dollar underpinned most of those reserves because it provided the most level of protection of value as well as liquidity. Now, the fact of the matter is that, as we already talked about, gold doesn't rely on any payment systems or corresponding banks or political relationships. That characteristic has become materially more important than it was a decade ago. Another major driver of gold has been the issue around real interest rates, right? Gold competes with cash and bonds, but that doesn't compete with the share market. When inflation-adjusted yields fall, the opportunity cost of holding gold declines. Investors don't buy gold to generate income. They buy it when they are uncertain so that it is a better storage of value. It's seen as a safe asset that will preserve purchasing power into the future. Gold in of itself is almost the opposite of betting on growth. It's insurance against monetary miscalculation. If we consider that the total gold demand reached a record 4,974 tons in 2024, equivalent to roughly in US dollar terms $382 billion, most of this was supported by central bank purchases, jewelry demand, and a return of investment flows into ETFs. That is not fringe demand. That is system-level participation.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
If we look at the other precious metal though, silver, it tells a bit of a different and more complex story. Silver is traditionally, if you think about, for example, at the Olympics, obviously gold and silver than bronze, right? So silver is often described as a cheaper version of gold, but that characterization or comparison factually is incomplete. Because silver is both a precious metal and an industrial metal, and this dual role is critical to understanding its price behavior. Unlike gold, which is dominated by investment and reserve demand, silver has significant industrial applications. More than 50% of total silver demand now comes from industrial use. Silver is essential in electronics, medical equipment, electric vehicles, and most importantly, solar energy. And in the century, where we keep talking about the importance of climate change and moving to renewable energy, inclusive of solar, this becomes a slightly different story than simply a storage of value like gold is. In 2024, total industrial silver demand reached approximately 689 million ounces. And of that, solar panel production alone consumed 243 million ounces of silver. So that's a bit over a third, about 40%. Now, every solar panel requires silver for its conductivity, and once that silver is embedded, it does not easily return to the market. So this makes solar demand structurally sticky. At the same time, silver is also an input into EV batteries. And despite your view on whether or not the demand for EVs is increasing at a rapid pace in Australia, you just look globally and you can see the demand is there and things are changing. Therefore, structurally, the demand of silver will continue to grow. The problem, though, is like just with any other commodity or asset, supply and demand are both just as important. And silver supply has been unable to keep up. The silver market has now experienced 5 consecutive years of structural deficits. In 2024, the global silver deficit was approximately 148 million ounces. So this means that the world, right, the demand of Silver was 148 million ounces more than what we could supply or dig out of the ground. And forecasts of 2025, because obviously a lot of that data will take months to come out, suggests that the deficit is around the same level, marking the 5th straight year where consumption has exceeded production. And this supply issue is not easily resolved. The majority of silver is produced as a byproduct of mining other metals such as copper, lead, zinc, and in actual fact gold. So that means silver supply in of itself doesn't respond directly to silver prices. Even if silver prices suddenly shoots up, miners just can't simply produce more and more silver unless the economics of the primary metals they are targeting also improve, being copper, lead, zinc, and gold. And this structural imbalance is why silver behaves differently from gold. Gold tends to move steadily and methodologically. Silver tends to trade sideways for long periods and then move rapidly once supply constraints become unavoidable. Gold, on the other hand, moves like a tanker. Silver moves like a speedboat. One of the most useful ways to analyze the relationship between gold and silver is through what we call the gold-silver ratio. The ratio measures how many ounces of silver are required to buy an ounce of gold. And since the 1970s, the long-term average gold to silver ratio has been 65:1, meaning that if you buy 65 ounces of silver, that is the equivalent to 1 ounce of gold. But during periods of financial stress, the ratio tends to rise as investors favor gold over silver. And during periods of economic expansion or reflation, the ratio tends to fall as silver's industrial demand becomes the focus of people that are trading the commodity. In April of 2020, to give you an example, which is just as we peaked past the share market crash during COVID, the gold-silver ratio spiked above 120:1. Okay, so 120 ounces of silver equals 1 ounce of gold, one of the most extreme readings ever recorded. Okay, so we're looking at quite extreme examples, and that reflected a world that was shutting down, industrial demand collapsing, and investors naturally wanting to hoard gold. As of the beginning of this month, being January, the gold-silver ratio has compressed to approximately 56:1. Okay, so lower than the long-term average, but very, very far away from that peak during the pandemic. And this compression of itself from its long-term average of 65 down to 56 is significant. What it suggests is that silver is not simply being pulled higher by the gold price, but it is outperforming due to genuine demand pressures. For the reasons I said before, silver has a massive use in industrial production, including electric vehicle batteries and solar panels. And historically, when the ratio compresses from those elevated levels, silver has often continued to outperform gold for a period, although, as always, nothing is guaranteed. Now, the gold-silver ratio in of itself should not be viewed as a forecasting tool, and it's certainly no crystal ball, but it is better understood as a temperature gauge. What it helps us do is it helps us understand market conditions, but not predict the exact outcomes. And right now, gold is signaling rising concern about monetary stability, geopolitical fragmentation, and real interest rates. Silver is signaling strong industrial demand and persistent supply shortages. And when both metals rise together, it often means the global system is under strain in multiple dimensions at once. Looking ahead, several indicators will remain critical if you are looking to analyze this area further. Central bank gold purchases will continue to shape long-term demand. Real interest rates will influence gold's opportunity cost, and industrial demand, particularly from solar and electrification of vehicles, will drive silver consumption, pardon the pun. Ongoing silver supply deficits matter because the shortages that last for 5 years, it doesn't exactly resolve overnight, right? We've been short for 5 years straight, no different to the ongoing housing shortage in Australia for new houses. It doesn't fix in a week or a month or a year or a few years. It takes a long time. And finally, the gold-silver ratio will remain a useful lens through which to assess whether markets are pricing in fear, growth, or sometimes both simultaneously. Gold always reflects confidence in money and institutions, and never forget about that. Whereas silver reflects the pressure of the real economy. And when they rise together, it's rarely noise. It's usually some sort of signal. I hope you enjoyed this episode, and as always, happy to take feedback on all the socials, and looking forward for you guys to tune into the next one. See you later.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.